It is the 15th day of January, the year 2009. And US aircraft, uh, Airbus A320 flight number 1549, leaves LaGuardia Airport headed to North Carolina. And in the cockpit, we have Captain Chesley Salenberger and his first officer, Spites. Now, a few minutes into the flight, the Airbus A320 Airbus hits the Canadian flock, and both the engine of the aircraft loses power. This, therefore, the plane cannot continue to go to the destination of North Carolina as it was meant to be. On board, there were 155 souls, 5 crews, and 150 passengers. Now, Chesley Salenberger cannot continue with the journey. He had to turn around and go back to either LaGuardia Airport or land to the next available airport. Now, as he continues with the journey, the aircraft is continuously losing the altitude. So therefore, the only place that he could land was in the Hudson River. So Chesley Salenberger takes his airline and glides over the river in the Hudson River. 155 souls, all of them rescued. No fatalities except only 2 injuries, but there was no death. All the 150 passengers and 5 crews, all of them survived. Today it is known as the miracles of the Hudson. So, viewers, today I want to welcome you in this episode where we want to talk about starting business without money. Starting business without money. We know very well for sure that every business requires finances. But today we want to share the sources where we can get the funding of the business. So welcome aboard in this episode from now as we move forward to the end of the show. Welcome, and as we take off. Now, just like I have told you about the US Airways Airbus A320 and the Captain Chesley Salenberger, in the business also we need to have a safe landing, and one of the safe landing is the capital for the business. So today in this show I want to navigate you through these safe landing avenues where you can get capital and bring the business up, where you can get the funding and make your business to thrive. So therefore we shall begin. The first place, Chesley Salenberger understood himself. He knew, he asked himself what he had. So today I want to tell you that if you want to start a business, you need to know who you are. Because even if you are given $1 billion capital and yourself, you don't have the capacity, you don't have the zeal, you don't have the motivation to do that business, to start up that business, you are headed nowhere. So you need yourself. Yourself is the biggest asset, is the biggest capital that one can have and to start the business, because you can have the money, yet you don't have the skill, you don't have the zeal, you don't have the motivation to do the business. So yourself, you must be available for the business. When it means to wake up early to go and run your business, you must be there. Every time during the constraint in financial resources, you must be there. During the time the business is thriving, you must be there. Because every stage of business growth requires different models, different strategies to make the business to go up. When the strategies that you employ when the business is down is totally different from the strategies you employ when the business is at the middle level, and as well when the business is at the peak. You need the strategies to keep the business while at the peak, because at the peak it is the area that you can easily make the business to go down. So therefore, yourself, your availability of yourself, availability of your management style, availability of you in person, or the systems that you employ in your business is very key. Number two, another place where we can get the source of funding or the capital for the business is financial institutions. Financial institutions, they include banks, they include SACCOs, they include MFIs, they include SMEs, and many more. Those are the places you can get capital. Now, in the bank or any financial institution, it's a place where all the people converge. Whether you are rich, where you are poor, all of you converge at the bank. Why? The poor person will take his money, or an average person will take his money to the bank. For the reason, savings. For the reason, fixed deposit. And now when the money has been taken to the bank by the person who don't have the idea on how to use his money, the person who is constrained, he does not know how to invest his money in other businesses, he will take his money to the bank and puts it in a savings account, puts it in a fixed deposit account, and most of the time, these fixed deposit accounts have a 10-year period. Now, when he brings this money into a fixed deposit or a savings deposit or a savings account, the bank will convert it into credit facilities. Now, a person who is rich in the mind, who is rich with an opportunity to invest in, who is rich with a business model, will go to the bank, get the money that was brought in by the person who doesn't have the opportunity to invest the money that was brought in by a person who had postponed his investments to other periods, other years. This person who is rich in the mind, rich with a business opportunity, rich with an investment venture, will come and borrow the money. Now, when he comes to borrow the money, he will take the money, go invest into a business, go invest into a company, and makes profit. Now, from the profits that this investor will make is when he will begin now repaying the loan. He will begin repaying the loan. And most of the time, you will find, because the banks are also in the business, the rate of return for this person who has borrowed is always higher than the rate of return that is given to this person who brought the money for fixed deposit, who brought the money for savings account. So therefore, a financial institution is also a very good place where you can get funding for your business. And that is the only place you can borrow, and no one even recognizes you on the road while you are working or your business, when you are doing your business, when the people comes to your business, and they don't seem to know that you are living on a borrowed capital. So financial institution is another source of funding. Another place, another source, precious investors, viewers, another source of funding to your business, another source of funding for your company, another source of funding for your investment is your customers. Is your customers. The customers are always key to any business because they are the one who consumes what is produced by the company. So today I want to encourage the producers, I want to encourage the companies that whatever you produce, you must be ready to consume it. Because if you produce a substandard item, definitely you as a person, you will not consume it. But if you produce a good quality product, you produce a highly researched product, definitely you will have people to consume it. And those people who consume it are called customers. Or in another language, we can call them debtors. Now, how can you get funding from the debtors? How can you get funding from your customers? Now, when a customer continuously purchases the product from you, the first month, the second month, and the customer feels you are satisfying him, the customer finds that you are producing the quality he wants, you are producing the desired specifications, the customer will become loyalty to you. So how can you meet loyalty? Is by satisfying your customer, producing the quality that is needed by the customer, making sure that whatever you produce meets the specifications of the customer. Now, once you have met the desired specifications of the customer and you are in financial crisis, the customer will not want to lose you. The customer will not want to get the same product from another supplier. The customer will always want to come to you for the same product. Now, so because of that customer loyalty, the customer will be ready to fund that good quality. The customer will be ready to bring on board money to bring up that quality that he so desires. So, for you to get funding from the customer, make sure you produce the quality that is up to the standards of your customer. Because if you produce a substandard product, why should the customer invest in something that is not meeting the criteria, something that is not meeting the desired specification? You are not satisfying him. Why should he invest in a product that is substandard? So for you to get funding, make sure that you win the loyalty of your customers, and for sure they'll be willing to support you. Now, I want to bring you another source of funding to your business. Another source of funding to your business is your suppliers. Your suppliers, the creditors to your business. Actually, they are creditors because they sell the products to you on credit. They bring the product, you sell, you pay. Later, they bring the product to your business and they give you some time for you to make the payments. Now, how can you get funding from them? Suppliers. How can you get the funding from the suppliers? Number one, you go and negotiate with the suppliers for a longer credit period, from 30 days, 60 days, or 90 days. And most of these suppliers, depending on the volume of the business that you are giving them, they will agree to that. Imagine a supplier giving you products worth 1,000,000 shillings. Let's say in Kenya, 1,000,000 shillings, or 2 million, or 10 million, or 100 million, whichever the amount, whichever the size of your business. And the supplier gives you 90 days to pay for those products. Is that not a source of funding? Is that not the capital required for you to run the business? So, a supplier can also become a great source of funding to your business. And for you to access this, you need to be in good relationship with your supplier. You need to grow the relationship, mutual relationship, because the customer is the supplier is benefiting, and you are also benefiting. The customer is giving you products. That is how he benefits, because when you sell this product, you pay him, and on your end, when you sell the products that you were supplied by supplier A, and you sell the product to customer B, you make a profit. So therefore, that mutual relationship between you and the supplier will guarantee you get the source of funding to your business. Viewers, I want also to bring on board to your attention another source of funding, which is partnerships. Partnerships. Now, partnership, there are so many ways you can get partners. The suppliers of goods and services can also become your partners. The customers who are buying your goods and services can also become your partners. Now, I want to first deal with the side of the customer who becomes your partner. Number one, when the customer becomes the partner of the business, it means because at the end of any financial year, this very customer, this very debtor wants to get what we call dividends, wants to get what we call royalties. Definitely, this very customer will now bring into the company the whole business. Other than sourcing products elsewhere, the customer will bring the whole of his business into the company because he knows at the end of the financial year there is a financial benefit. So the customer will become your partner by bringing the whole business into your business, by also investing, bringing in money into your business. Now, when they bring the whole business into you, it means now your portfolio grows. Now your investment will go up because the products that this customer was buying from another person, it has come into your business. The money this customer was spending into another business has now come into your business. So therefore, your portfolio definitely grows. Your portfolio definitely expands. Now, when this person is motivated by the dividends, the share of profits at the end of the financial year, so definitely that is the key reason he wants to bring his business into your business. So therefore, partnerships is also another source of funding. And in this case, it is partnership because of sharing the returns from the business, the profits of the business. Now, another source of funding, viewers, that I want to bring on board is the family. If you want to start up the business, if you want to start up the company, you will need capital. And this capital can also come from your family people, your brothers, your mother, your relatives, your spouse. The spouse can go into a financial institution and borrow on your behalf. Your mother, from her own savings elsewhere, can bring capital to your business. Your relatives, your brothers, your cousins, they can also bring in money into your business. Now, these people, the good thing with these people, relatives or friends, the good thing with these people, when they bring money into the business, they will give you time because they are your relatives, because they are your parents, because they are your brothers. When they bring money into your business, they will give you time. They will give you time to turn around your company. And once you begin making profit, when you begin making some returns, that's the time you begin paying them. And most of the time, the capital that you get from your family members, your relatives, your friends, your brothers, this capital that comes into the business from these people, most of the time, it is, number one, interest-free because of the relationship. Most of the time, it has a longer repayment period. It doesn't have a formal repayment period whereby if you don't pay by this time, you begin incurring penalties. No. Most of the time, this money that they bring into the business is money that doesn't attract any fee. Because if you go to a financial institution for a credit facility, there is insurance, there is commission, there is processing fee, there is exercise duty for the government.